Volatility in high-stakes financial markets is rarely random. Instead, it is the direct byproduct of invisible structural forces. To see these forces at work, we rely on a liquidation heat map, a forensic tool that maps the exact coordinates of structural market fragility. Retail traders often look at dense bands of limit orders and assume thick liquidity provides support or resistance. They expect these zones to act as a wall that bounces the price. In reality, price functions as a liquidity-seeking mechanism. It is drawn directly into high-leverage pools to fuel momentum and engineer reversals. Mapping these zones of market gravity provides the structural context needed to anticipate volatility before the orders hit the tape. We can trace this mechanical behavior by looking at a closed-loop market cycle spanning 5 days, from August 20th to August 25th. This chart shows the starting market conditions. At midnight on the 20th, the market is in a consolidation phase, and leverage is already clustering around the spot price. On this map, the bright yellow and green horizontal bands signify high-density liquidation interest. The darker the purple, the thinner the liquidity. Over this 5-day window, this dataset will reveal 3 distinct phases. First is the squeeze, next is the trap, and finally the chop. Tracing this chronology reveals the mechanical transition from explosive short squeeze momentum to a long leverage collapse. As August 20th begins, heavy short leverage clusters are forming strictly above the current price action. Look specifically at the thick yellow bands stacked between $69,000 and $72,000. This creates a structural vulnerability. When a short position is liquidated, the exchange mathematically forces a market buy order to close the trade. Institutional algorithms identify these bands as targetable liquidity. These clusters allow large entities to clear massive books without creating significant slippage. Watch the price action as it begins to drift upward. It touches the lower boundary of this dense cluster right near 72,000. Rising prices trigger automated buys, which push the price higher still, immediately hitting the next band up. The cluster provides the fuel for its own consumption. This cluster exerts a mechanical pull, drawing price directly into the liquidity needed to satisfy the exchange order book. This chart captures the first 12 hours of expansion. The price action carves through the $74,000 level, consuming the upper yellow bands. Forced buys drive the price up, hitting more liquidations and generating further buy pressure. This feedback loop creates the squeeze effect. Moving into August 21st, the price aggressively enters the $78,000 to $80,000 range, meeting the final overhead liquidity. Notice the dark purple gaps where yellow bands were located just hours prior. They have been entirely consumed and converted into market orders. Price loses momentum at the peak because it has exhausted the overhead fuel source. Following this exhaustion, the price action stalls and corrects slightly away from the $80,000 level. This vertical move cleared the existing shorts, while simultaneously attracting a massive wave of late-arriving long leverage at the local peak. The rally terminated at the exact point where the short liquidation clusters ran dry. By the start of August 22nd, the market topography has shifted entirely. Look at these dense, multi-layered bands now forming below the price action between $76,000 and $79,000. These bands represent late longs entering the market with tight stops and high leverage at the top of the rally. While retail traders may perceive this as a strong floor of support, it represents a massive pocket of sell-side liquidity for institutional desks. With the overhead liquidity removed, there is no longer a structural incentive for the price to move higher. The market is now top-heavy, and its current position is reliant on a thin floor of highly leveraged long positions. The existence of this dense liquidation floor now represents the most significant point of failure for the current price structure. We can now examine the micro-mechanics of the liquidation event that followed on August 22nd. This chart captures the initial breach. Price cuts vertically downward, slicing through the $76,000 support bands. Long liquidations trigger forced market sells, driving price into the next tier of liquidations instantly. Look at the aftermath of the flush. The chart shows a dark purple void where the major support bands once were, as price stabilizes at $76,000. In a single 4-hour candle, the market erased thousands of dollars in price value. Institutional buyers often hide massive orders at the bottom of these cascades, letting forced retail sellers fill their books at a discount. Once the cascade completes, the price action moves sideways. The leverage is cleared, and the order book has returned to a low-leverage state. This was a highly efficient clearing of a structural weakness that had built up within the order book. Moving to August 25th, we can analyze how leverage reclusters in the post-cascade environment. Tight yellow bands have formed simultaneously above and below the price action near the $80,000 level. This creates a state of chop, where price whipsaws between these tight bands to harvest localized clusters of leverage. Notice the price action trending downward specifically to consume the lower yellow bands at $79,000. By the end of the timeline, price has tapped $79,000, cleared the liquidity, and initialized a reversal, leaving the previously bright bands empty. High-leverage retail traders are systematically hunted in this environment, as the market sweeps stops on both sides of the trade. In a chop phase, the proximity of localized liquidity dictates price movement, regardless of the macro trend. The August 20th squeeze and the August 22nd cascade represent two sides of the same mechanical behavior. The logic that fueled the rally was identical to the logic responsible for the crash. Market movement follows the path of least resistance toward high-volume execution, independent of any external concept of fair value. The heat map reveals where the market is most fragile and where forced execution is inevitable. Advanced analysis requires seeing through the price action to identify the underlying fuel. Where the leverage clusters, the price follows.